Have you ever wondered how to evaluate a stock? It's a question that puzzles many, but today we're going to demystify it. Stock evaluation, simply put, is the process of determining the intrinsic value of a stock. It's like peeking under the hood of a car before buying it. You wouldn't buy a car without checking its condition, right? Similarly, you wouldn't want to invest your hard-earned money in a stock without understanding its true worth. This process is crucial for both beginners dipping their toes in the ocean of investing and seasoned investors who've been navigating these waters for years. Today, we'll embark on a journey to explore the key steps involved in stock evaluation. We're going to talk about understanding market basics, delving into company financials, examining key financial ratios, and the role of industry analysis. Now that you know what to expect, let's dive into the fascinating world of stock evaluation. Before we jump into evaluating a stock, it's crucial to understand some stock market basics. So let's start with the fundamentals. A stock, also known as equity, is a type of security that signifies ownership in a corporation and represents a claim on part of the corporation's assets and earnings. Now, you may have heard the term share being used interchangeably with stock. A share refers to a single unit of stock. For instance, if a company has 100 shares of stock outstanding and you own 10, you own 10% of the company. Moving on, let's talk about dividends. Dividends are a portion of a company's earnings that are paid out to shareholders, typically on a regular basis. Not all companies pay dividends, especially those in growth phases, as they may prefer to reinvest their earnings back into the business. However, stable, well-established companies often provide dividends as a way to share their profits with their shareholders. Next, let's define the stock market. The stock market is a marketplace where buyers and sellers trade stocks. It acts as a platform that brings together individuals and institutions interested in buying or selling shares. The purpose of the stock market is to facilitate the exchange of securities between buyers and sellers, reducing the risks of investing. Investors play a crucial role in the stock market. They provide companies with the capital they need to fund their growth and operations. In return, investors hope to profit either from future cash flows or from selling the stock at a higher price than they bought it for. It's important to remember that investing in the stock market involves risk. The value of stocks can fluctuate greatly due to a variety of factors, including economic conditions, company performance, and market sentiment. However, with careful research and prudent decision-making, investing in the stock market can yield significant returns. With these basics in mind, you're now ready to delve into the process of stock evaluation. Company financials are the backbone of any stock evaluation. But what do we mean by this? Well, let's break it down. Imagine you're a detective, hot on the trail of a potential investment. Your clues, company financial statements. These reports reveal a company's economic health, and they're essential for making informed decisions on whether to buy, sell, or hold a stock. Company financials are made up of three key reports: the income statement, the balance sheet, and the cash flow statement. Each of these documents serves a unique purpose, and together, they paint a comprehensive picture of a company's financial standing. First up, we have the income statement. This report shows a company's revenues, costs, and profits over a specific period. It's like a movie trailer, giving you a glimpse of the company's earning power. If the income statement shows consistent profits, it's a good sign that the company is in a healthy financial state. Next, we have the balance sheet. This document is like a snapshot, capturing a company's assets, liabilities, and equity at a single point in time. It provides insights into a company's financial structure, revealing whether it has enough assets to cover its debts. Finally, we have the cash flow statement. This report shows how much cash a company generates and spends over a period. It's like a company's bank statement, showing whether the company is generating enough cash to fund its operations and grow. Remember, financial statements are more than just numbers on a page. They're stories, revealing the highs and lows of a company's financial journey. By understanding these stories, you can make sense of a company's past performance and anticipate its future. In conclusion, company financials are critical in evaluating a stock. They provide a wealth of information about a company's financial health, profitability, and growth potential. By understanding a company's financials, you'll be able to make informed decisions about the stock's potential. Now, let's talk about the key financial ratios that you should consider while evaluating a stock. First up is the price to earnings, or PE ratio. This is calculated by dividing a company's current market price by its earnings per share. The PE ratio gives you a snapshot of what the market is willing to pay for a company's earnings. A high PE ratio could suggest that the market has high expectations for a company's future earnings growth, while a low PE ratio might indicate that the market has lower expectations. Next, let's take a look at the debt-to-equity ratio. This ratio is calculated by dividing a company's total liabilities by its shareholder equity. It provides insight into a company's financial leverage and how it funds its operations. A high debt-to-equity ratio might suggest that a company has been aggressive in financing its growth with debt, which can be risky. On the other hand, a low debt-to-equity ratio could indicate that a company has not taken on much debt, suggesting a more conservative approach. Lastly, we have the return on equity, or ROE. This is calculated by dividing a company's net income by its shareholders' equity. The ROE gives you a sense of how effectively a company is using its equity to generate profits. A high ROE might suggest that a company is generating a good return on the money it has been given to work with, while a low ROE could indicate that a company is not generating a good return. Remember, these ratios should not be used in isolation, but rather as part of a broader analysis of a company's financial health and performance. It's also important to compare these ratios against those of other companies in the same industry, as what might be considered a good or bad ratio can vary widely between industries. These financial ratios are like a magnifying glass, giving you a closer look at the company's financial health. But evaluating a stock isn't just about crunching numbers. Industry analysis plays a vital role too. Imagine a company as a ship sailing the vast ocean. Its performance isn't just about the strength of its hull or the skills of its crew, but also about the waters it navigates. That's exactly how industry analysis factors into stock evaluation. The industry a company operates in can greatly affect its performance. For instance, a company in a growing industry might see increased opportunities for profit and expansion. On the other hand, a company in a stagnant or declining industry may face more challenges in maintaining profitability. But it's not just about the industry's overall health. Trends within the industry can also impact a company's performance. Let's say, a new technological advancement could offer new avenues for growth, or it might pose a threat to existing business models. Then there's competition. A company's competitive position within its industry can be a key determinant of its success. If a company leads its industry, it might have more power to set prices and standards. But if it's a small fish in a big pond, it may have to fight harder to stay afloat. So when we evaluate a stock, we don't just look at the company's financials. We also look at the waters it's sailing in, the winds of trends, and the other ships it's up against. Remember, a company's performance is not just about its own operations, but also about how it stands in its industry. So, you've understood the basics, looked at financials, analyzed ratios, and considered the industry. What's next? Let's bring it all together. We started our journey of stock evaluation by understanding the stock market basics. We learned how stocks work, what drives their prices, and the significance of buying and selling. We then delved into the importance of company financials. Remember, the balance sheet, income statement, and cash flow statement are your maps to a company's financial health. Next, we turned our focus to those key financial ratios: price to earnings, debt to equity, return on equity, and so many more. They're like compasses guiding us through the financial wilderness, helping us understand whether a stock is overvalued or undervalued. And let's not forget about the role of industry analysis. It's crucial to understand the larger picture, the industry's trends, and the company's position within it. Like a weather forecast, it helps us predict the possible future of our investment. Each of these steps is a vital chapter in the story of stock evaluation. They all come together to form a comprehensive picture, helping us make an informed investment decision. Remember, knowledge is power, and in the world of investing, it's your most valuable asset. Evaluating a stock may seem complex, but with these steps, you're well equipped to make smart investment decisions. Happy investing!